Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Brian Dowley. Thanks for being on the show, Brian.
Hey, thanks for having me. Glad to be here.
Brian's the CEO and co-founder of Groundfloor, which launched in 2013 with the idea of opening private capital markets to all based on the Jobs Act of 2012. Am I saying that right, Brian?
Yeah, we can get into that for sure.
All right. And Brian and his co-founder, Nick, took the original idea and brought it into real estate, creating an investing and lending platform that makes it much easier for everyone to participate in real estate projects in a fractional basis. Brian, thanks again for being on the show today, and I look forward to learning more about the crowdfunding. And I hear that more and more, and people talking about maybe they want to start their own crowdfunding platform, and obviously you're very experienced in that. But get us started a little bit about your background and what Groundfloor is.
Sure, I met my co-founder in actually 2012, and we incorporated the business about 6 years ago. When we met, we had a particular idea about finance that observed that, when you look at the vast majority of investment opportunities out there, some of the best ones are in private markets. And we thought that was problematic for most investors who were stuck in public markets, felt like maybe the game might be rigged, were looking for alternatives, but some combination of practical reality and what it takes to syndicate private deals. I mean, we all know how expensive that can be and how difficult and time-consuming it can be to manage. Some combination of that and securities law, was keeping 95% of us out of the game, if you will. And we started working on ways to address that. First with securities law, but then also using technology to syndicate deals. And, radically, we set a target for ourselves to be able to do it at a $10 minimum investment. And that's still where the business is today. So in a world where it's $1,000, $5,000, $25,000 to participate in a private securities offering, a private deal, we now have thousands of people doing that at a $10 minimum. So we've used technology and regulation to do that over the last 6 years. Wow.
So I guess tell us, like a Groundfloor. What is Groundfloor? How do you all? What's your business? What's your typical client, and who can invest in that?
Well, so we observed this general problem in investing, right? And neither one of us came from the real estate industry, and so we didn't start off saying, "Boy, the world needs another real estate syndicator or another real estate lender." We didn't identify a particular problem in real estate itself. What we observed is we tried to figure out what would be a good area in which to create a financial product like this. We realized real estate was it, because at any given time, 60%, it used to be 2/3 of Americans are already an investor in real estate because they own a home, and it's the most significant asset on their balance sheet. We also realized that people were familiar with it. They could watch house flipping shows and learn about how investors make money in this asset class. And, the flip side of that is we needed a product that had a very high yield. Our product yields about 10 to 12%, depending on how you're managing the risk of your own portfolio. And it needed a short term. With a new product like this from a new it's a new product from a new company in a new category nobody's ever heard of. We knew we needed an attractive investment return. So our product, ended up being at the very beginning, we do more than this today. It ended up being house flipping loans for guys who are out there acquiring $50,000, $60,000, $100,000 properties, fixing them up for about the same amount, and then hopefully turning around for a really good return on their investment. That really worked because it's not easy to get 10% on your money, certainly on a term of 8 to 10 months. That's just less than a year. That's pretty hard to find out there. So the product really took off for us with that first offering of kind of house flipping loans.
Nice. So talking about like crowdfunding versus syndicating, and you talked about the expense of syndicating and managing it, and tell us the difference between that and why someone would go the crowdfunding route.
Well, I'll tell you, we didn't start off thinking of ourselves as crowdfunding, right? People use that label. I mean, when I think of crowdfunding, I think of Kickstarter. You think of a band you like, or an artist, or a hardware product that you want, and you're going to chip in to fund it. You're going to get the t-shirt, and you get the first product. But to me, that's crowdfunding, right? I don't know whether that model works for a large number of real estate projects, right, that we would want to finance. I think it works for, impact projects probably, right? But for your garden variety, day in and day out, what investors want to do to just make money and put money to work, I'm not sure that model makes a lot of sense. At the other, some people might say the same thing about syndication if they haven't done it, right? They might say, oh my gosh, it's so expensive to put these investors into a vehicle and then manage them, and raising the money takes a long time. We tried to drive right in between those two approaches to create a financial product. So we actually, we don't syndicate each deal. We don't go create a special purpose vehicle for each deal. I mean, why would you do that? Our average loan size is $150,000. This is not worth it, right? I think we can all agree on that. What we did instead is we created a financial product that we've qualified with the SEC. And that financial product is set up in a very regimented, kind of standardized way that when we originate a loan, it comes in, it has to meet these criteria. There are grades, 8 grades, A through G, that, you can choose different leverage points, or if you're less experienced, you're going to be in a lower grade. There's variation in it, but it's very highly standardized. And that's how we solve the economic problem of syndication or crowdfunding. We take the cost of setting up that offering, the audit and the securities law compliance and the disclosures, and we amortize it over hundreds and thousands of deals and thousands of investors. So I think that's how we broke loose and got into hypergrowth mode, because we figured out how to do that at scale. And I realized if you're really trying to crowdfund each deal, it'd be really expensive. Just like if you're just trying to syndicate each deal, the deal better be big enough and worth it enough, to bear those costs.
That's right. Because it's not cheap. That's for sure.
No. And it takes a lot of expertise, right? And the people who know how to do it, the advisors who know how to do it, the auditors who know how to look at it, to incur those costs every time, we knew for us, for what we were trying to do in the markets where we operate, that wouldn't make sense.
See, you had mentioned like syndicating keeps 95%, the people out of the game. And so how does that, how does it not that way with your platform?
Well, I mentioned this process that we went through to qualify our offering with the SEC. Under securities law, as you know, because you've dealt with this a lot, if you are going to offer securities to the public and advertise them, and encourage people to invest in them, you have to register that security. If you want to list on a public exchange and IPO, you got to register that security. There are exemptions to registration. The most common one is the accredited investor exemption. And, if there's 4 or 5% of households that make enough money or have enough wealth to qualify for that, everybody else is left out in the cold. So we went and, took a very long time and a 7-figure sum in order to make this work the way that it needed to work to be efficient. But we got it done. And we're the only issuer that has ever qualified for a direct offering of these sorts of securities. Anything else you see out there that uses Regulation A, that's the exemption that we use, is a REIT. And we don't think the world needs another REIT. Plenty of REITs. What happens when economic times get tight is REITs clamp down and you can't redeem your shares anymore. We saw that in every real estate contraction. You see that they're all starting to do it even now and starting to threaten that they're going to do it. You get control with this product, and that's what we're proud of. So we wanted this to be as efficient as a fund, but to give you the control of making individual investments. That's what's different about it.
Elaborate on that control a little bit. And you mean the investor has a lot more control?
The investor has all of the control. The investor picks which deals they want to participate in. how much money they want to put into each deal. Anywhere between, you see people invest anywhere between $10 per deal into 100 deals, and they have $1,000 at work, because maybe they're just getting started investing. Maybe they're they're just getting started. They don't have a big portfolio yet. And we have people that invest $10,000 per deal and have $1 million at work. We have people like that, and everything in between. But the important thing is that the investor gets to choose. And so, you build your own portfolio. There's nobody telling you. I mean, if I told you could invest in the stock market, but you had to, in order to do so, you had to buy an ETF or you had to buy a mutual fund, you look at me like I was crazy, right? You tell me that's an un-American idea. What do you mean I can't buy Facebook stock? Well, with us, you can choose. And what people really do with it is they choose how to allocate, how much risk they want to take, maturity risk, term risk, for what percentage yield. And some people really get into the real estate investing part of it, and some people just get into the pure financial return out of it. And you really have the choice about how you use the platform as an investor.
So as the investor, do I know who the operators are of the properties that I am investing in? Can I do any kind of research about them?
Absolutely. Yeah, we put them all through a screening process. We disclose who the principals are, and who the entity is, and what track record they have with us, and what track record they have besides. And it's all very, very open. Good thing as the user of the capital, the borrower or the syndicator, you don't have to worry about having this legal relationship with hundreds or thousands of investors. We handle all of that, all the investor relations side of it for you.
So, what about pros and cons of using, accredited and non-accredited? I would imagine, or maybe do you know the percentage of accredited versus non-accredited that you all have of investors, and pros and cons?
What I like to say is, it's because it's really true, and we're pretty proud of it, is our investor base looks like America. About 5% of them go through the accreditation process, sign the form and are accredited investors. 95% of them aren't, and that it really does look like, what the macroeconomic data would tell you. Of course, the accredited investors have more money to invest. That's for sure. So they punch above their weight in terms of how much money they put in. But yeah, no, it's broken down exactly like you would expect it to. The great thing about these accredited investor offerings, right, is just as an issuer, you have unlimited flexibility, right? For Groundfloor, we have to, unlike competitors who are just bringing in accredited investor capital, we have to report to the SEC on our performance regularly. We have to file audited financials, semi-annual, or audited financials annually, financial statements semi-annually. We have to maintain disclosures. We actually go to the SEC for regular qualifications. We qualified over 85 offerings, that have loans, amended or offering of 6 to 12 loans in every batch. So we have a heavy regulatory burden we're amortizing it over hundreds and thousands of loans. But that's a drawback to opening it up to everybody. I like to think that even for the accredited investors, it's really worth it because we disclose everything in the same way a public company would, right? Instead of investing in a private placement where, maybe there are disclosures, maybe there are not. With us, every disclosure is there, and you know what you're getting. So a lot of accredited investors appreciate that. They get that extra sense of security and safety.
So what other drawbacks, would you say there are to a crowdfunding platform or like what you all have?
Well, one big drawback is we don't have, this product isn't far enough along in its evolution to finance really large deals, right? So if you want to finance a, $1 million, plus multifamily project or commercial project, it's tough to crowdfund those. It's tough to use this form of syndication because, we're preaching diversification. The average investment in one of our loans is about $200. So $1 million, $200 at a time to get $1 million is a lot of people. And these platforms aren't that big yet. We're not like Barclays, right? With so many ETFs and so many people using them and trillions invested every year. We're not to that stage yet. We're much earlier stage, but it's growing. When we first when we first started, our loans were $40,000 and $50,000 loans. Well, not anymore. Now they're $150,000, $200,000, sometimes $300,000 loans. So we've really grown our capacity to fund. But it's, if you got a big dollar amount you need to raise, and you're really stuck going back, sticking with the accredited investors and the institutions that you've been using all along.
So do you see that in the near future? I mean, or do you see like a time frame to being able to do, $1 million, $2 million loans?
I mean, entrepreneurs are very bad at picking time frames, right? I mean, we're just terrible, because like, if you'd have told me 6 or 7 years ago that it was going to take me this long to get the company to where we are today, 50 employees, almost 10,000 active investors, if you told me that, I probably wouldn't have been quite as gung-ho. It's a long road. So we're pretty bad at picking timelines. What I can say is we are finding ourselves getting involved in larger transactions and finding ways to do that. Maybe we're going to be the mezzanine piece of a low leverage, first in the waterfall loan to get involved in some projects. So we're broadening. How quickly we broaden and using what structures is, over the next decade or so, we'll find out, how far that goes.
What makes you different from other similar platforms?
The ability for the non-accredited 95% to invest with control and to diversify at the level of $10 per investment, build a portfolio that you truly control, and to diversify that way is unique. And that's all because we're the only platform that has been qualified by the SEC. We're qualified 3.5 years ago. We're the only platform that's been qualified by the SEC to do that in that way with this kind of model. Everything else you see out there for non-accredited investors is a REIT. A REIT is not the same thing. There are some good things about REITs, but it's not the same thing as having individual control. It's either that or it's an accredited investor offering. So that's unique.
What are some systems that you've put in place to manage all this? I mean, it's amazing that, what'd you say, like 10,000 investors and 50 employees. So you got all this happening, right? I mean, so many things happening at one time. What are some systems that you've found that are excellent in managing all this?
Well, I'll tell you, there are 2 or 3 components to this that have had to come together over the years. The first is we have homegrown. We have built our own and have a homegrown investor relations platform. And that does everything from, helping you set up an account to, setting up a bank account to transfer money into your Groundfloor account, giving you a dashboard where you can see what you've invested in and how it's performing, linking up with our asset management group so that you know what's happening with all your investments. Every 30 days, you get a small update about the progress of your investment. And that's true across your entire portfolio. So we have to manage thousands of updates per year. It's pretty intensive, and we have an investor relations platform that does that. Soup to nuts. That's one component. There also, the lending business is not easy to be a lender. And we serve hundreds of borrowers at any given time as a lender. We're originating loans, and we have homegrown an origination platform that fits with our regulatory requirements, because we can't just originate anything we want to because we want to. We have to originate it in a particular way. And so we've homegrown a bunch of software to do that. That's why we have a big software engineering team. That's why we raised venture capital, as we grew up in order to afford that. And we're always going to be working on that. We're always going to be trying to build up the investor relations side of the house while also being a better originator and making the two fit together. We use Salesforce as a customer relationship management tool. It's a great platform. We use a huge stack of open source software that we customize in order to help us, build to that. We use marketing tools like HubSpot and MailChimp. A lot of these things a lot of people use that in this grand scheme of things aren't so expensive. But the insight to build this custom software to make this particular solution work is not for the faint of heart. It's a real technology challenge that we've undertaken over the last 6 years.
What's the best way you've found to nurture investor relationships and keeping you all top of mind?
Well, one, we are radically transparent. So, right from our 178-page offering circular that tells you everything about how we do everything, how we underwrite, how we grade risk, how we manage it. We are radically transparent about that. I think people really appreciate that in this world, that they can really see what's happening and understand it. We have boiled everything down to its essentials into a format that is digestible. I mean, if you're investing $200 in a deal, how much time are you really going to spend diligencing that deal? You can't afford to, right? So we've solved that information economics problem by giving you the essentials that you need to know what you're getting in this investment compared to others and to compare them. And we've done that pretty well. And then when we mess up, we admit it. We blog about it. We write emails about it. We're very forthright about it when we make a mistake or when something's not going right. And I think people have come to appreciate that. And, on those few occasions when that's made it impossible for us to return 100% of principal or not to pay all of the interest that's due, people appreciate at least that we're upfront about it, that we're not hiding it, not sweeping it under the rug, not trying to excuse it. But then also they see that plays in the other direction when they make more money on a deal that went sideways. And maybe it took longer, but we did a good job managing it. And so I think that's been important we have a set of values around here that we've stuck to since the very beginning. We're here for the individual investor and we're not going to let them down. And I think people who've been with us for a while know that. And I think that's how we've managed to the extent we're successful as a syndicator. And I think we have been, that's been key to our success. And I would say other people who are syndicating who've been successful will probably say they've done the same thing.
So how have you found the best way to advertise and to convert, leads into clients or investors?
I mean, it's hard to do. In the early days, it was me sitting on Facebook, programming Facebook ads, trying to figure out like what combination of pictures and text, do that. I mean, we could do that because of our SEC filings, and in the early days, we actually used the Invest Georgia exemption to pilot that concept here in Georgia. You can't just go advertise an investment opportunity without doing the regulatory work to be allowed to do that. But we used Facebook in the early days. Now it's a lot of word of mouth. Honestly, investors like to talk about and sort of spread the word about what's working for them. And fortunately, we are working for them and they are spreading the word about it. Unfortunately, if you're only marketing to accredited investors, it's a little hard because not everybody can invest. But in our case, everybody can invest, so word tends to spread. They get their friends and family going. Some people have their kids doing it. It's at $10 an investment, it's accessible to literally everyone who wants to start investing. So I think that's been a big part of the success.
Wow. So, I guess, did you all also raise capital to start the Groundfloor? We did. Yeah, we've gone through a few rounds of that. The early days was just like everybody. I mean, everybody can relate to this, right? It was friends and family capital. We scraped together whatever we could. I didn't make a salary for 2 years, because I wanted every dollar that we could raise to go into the software development or the marketing or, something to get us off the ground. And it was a painful period, really tough. Anybody who's been through that. And you really appreciate the angel investors who showed up and believed in the vision, believed you could do it, wrote those checks. I mean, in the early days, I think our first round was $125,000 was our first close. But then we went on to raise a total seed round, including that about $2.6 million. We were fortunate after getting qualified by the SEC in August of 2015 to raise a venture capital round of $5 million from a local venture capitalist who saw this as a really large, scalable opportunity. And then when we went for our most recent round of capital, we went to our customers and we crowdfunded the equity of the company. So we now have 2,400 shareholders who own about 14% of Groundfloor. And that's kind of cool because they're the people who benefit from the growth by having more investments and a bigger company and more opportunities to invest. And they've financed it, but then they're also going to benefit from the increase of that equity someday. Should we go public or go through an acquisition, they'll actually profit from that as investors. And that's very aligned with our mission too, because most people don't get access, to these pre-IPO, venture capital deals. And I'm hoping that this is a huge lucrative exit, for all of those people who believed in us and that they benefit from it. So
pretty excited about that. We're actually this year doing another round. Instead of going the venture capital route, we're doing it again. We're going right back to our customers and giving them an opportunity to invest at, the next round, which is at a higher price where people have made money on their stock. And hopefully we'll just keep that going, for many years to come until we get the company to its endpoint.
Brian, what's a way that you've recently improved your business that we could all apply to ours?
I'll tell you one thing we did that, I'd say one internal thing and one external thing. Internally, we learned the hard way that, we needed to be very serious about our values and putting those forward in how we hire people, how we reward people, how we develop people. We weren't being intentional enough about that in our early years. We kind of hired too many people too fast without that in mind. And one way that we've really improved our business this year is being very intentional about that. So I mentioned we doubled the size of our staff this year from 25 to 50 people in the last year. We adopted a values-led process to do that. And I think everybody can learn from that. Hopefully you don't make some of the hiring mistakes that we made with some of the, bad elements that, they seemed like they were real rock stars who were going to make a big impact. And boy, they were sure convinced of it too. And they let everybody else know, so we fortunately turned those people out, replaced them with people who are more in keeping with our values. And then I think the thing that we did externally that everybody could use is we were thoughtful about the point in time at which we expanded our product set. We've been very, very focused on our bread and butter of house flipping loans, that fit a certain pattern. This last year is the time we started to branch out into new construction loans, portfolio loans, some longer term rental property loans. So we've done that on the investor side and on the syndication side. And that, I think you have to be careful not to broaden the product set too soon, too fast. But we did that at a good time for us. And that was one external change we made to the business where I think we got the timing right. And really we did it by following our customers, frankly, following our customers to where they wanted us to go with them. And that was a good step that we took that I think anybody could take with their business.
Great. And Brian, before we have to go, tell us the number one thing that's contributed to your success.
Wow. I think being true to who you are, that's admitting it to the investors who want you to be something else. And if you can convince them that you're something else, that they'll write that check, don't do it. We have always been, I personally as an entrepreneur have been in contexts where I've seen other people deviate from their vision and who they are and misrepresent it or shade it. I've never done that with this company. And I think to the extent we're successful or I'm successful as an entrepreneur, it's because of that. If you are who you are, you're upfront about it, you admit it, and good, bad, or ugly, you'll attract the right people. Because having the right people is often a function of that and not getting the best people on paper. It's about the people who fit with you. And I think that's been I think we've done that well here at Groundfloor. I hope we always do.
I like that a lot. Good, bad, or ugly. I like that. You admit who and what you are, and you'll attract the right people.
Yep.
Brian, you've been a great guest. I really appreciate your time being on the show today. And would you tell the listeners how they can get in touch with you or learn more about Groundfloor?
Absolutely. I'm available via email, Brian with an I at groundfloor.us. Please drop me an email. I try to reply to every one of them. It might take me a few days sometimes, but I do. You can hit me up on Twitter at Brian_Daly. I'm accessible there, and our website is groundfloor.com. So check it out. Let us know what you think, and if we can be of any help, we'd be happy to other people who are going down this road.
Great. Thanks again, Brian. And I appreciate the listeners who have listened to the show today. And I hope you will go to the Life Bridge Capital and connect with me, and also go to the Facebook group so we can all connect with the experts like Brian and grow our business together. And we will talk to each of you tomorrow.
Awesome.
Thank you for listening to the Real Estate Syndication Show, brought to you by Life Bridge Capital. Life Bridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. Life Bridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.